Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, CPI data out tomorrow, what that means for the Fed's rate cut path, as Fed Governor Michelle Bowman calls for 3 cuts this year. Plus, NVIDIA and AMD pledging to pay 15% of China chip sales to the U.S. government in exchange for export licenses. This comes as the trade truce deadline with China looms. The U.S. and China still working to negotiate a deal before Tuesday. And the latest read on the software sector, how AI could disrupt the industry. All that and more coming up on Market Catalysts. Let's get a check of the markets here. We are seeing stocks push higher, but very, very modestly here today, as investors do seem to be awaiting that CPI data out this week for some more direction in the market here. The Dow just gaining under 8 points here. The S&P 500 very slightly in the green, trying for a record close today. Any gain for the NASDAQ will be another record, even if it is a modest, not even a 1/10%. And speaking of those expectations for the Fed, let's check on the bond market as well. We are seeing a really treading water here for the yield curve, the 10-year yield right now at 4.28%. Well, NVIDIA and AMD have agreed to pay the U.S. government 15% of their revenue stream of sales from chips to China. That's according to various reports. It's the latest agreement for an industry frequently disrupted by ongoing trade talks. Back in April, sales of NVIDIA's H20 chips were halted entirely by the administration. But last month, the tech giant said it was given permission, or would be given permission at least, to resume sales. Worth more on what this unusual deal means for the U.S. and executives trying to curry favor with the president. Joining me now is Terry Haynes, Pangea Policy founder, and Bill George, former CEO of Medtronic and executive education fellow at Harvard. Gentlemen, thank you very much for being here. We appreciate it.
Really appreciate it.
Terry, I want to start with you. What do you make of this agreement? Obviously, it is very unusual here for any other administration, maybe not as much for this administration, but how does this sort of, move things forward, both for these companies and for China negotiations?
Good morning, Julie. And a couple of things. One, I'm not sure it does for a very practical reason, which is, Secretary Lutnick was talking a few weeks ago about that this was the chips for rare earths was going to be some sort of a balanced deal that would work out. Well, we still haven't worked out the rare earths part of this, so I'm not sure that the chip thing's ever going to get done. Secondly, I think you're seeing on a broader scale here tech humbled, right? It's Trump apparently the last criteria here is a 15% payment out the door on the one hand. A strategy which I think would probably depress exports if it was administered more widely. And on the other hand, the Chinese are saying apparently that they don't want the chip after all because they're afraid of backdoors, which puts the tech industry in a position of having to show that there's no backdoors, and in the bargain where they might put backdoors. So, you've got a situation here where this isn't really good for tech, no matter how it slices. Finally, I think the Trump people probably end up with this as a one-off. There's going to be a lot of negative backwash here, but based on the concerns that this sort of strategy might spread beyond this particular deal.
Well, and Terry, I just want to follow up and ask about the national security concerns also, that, the folks who are sort of China hawks had expressed all along that there were reasons to not allow these chips to go into China, and getting some money from them doesn't really erase those concerns.
No, it doesn't. I will tell you I think that's an entirely legitimate question to ask. I think the tiebreaker here is I'll give it to Treasury Secretary Bessent, who said originally that this was something that the Chinese wanted. This was part of a broader mosaic of issues that the United States and China were working on. So they reluctantly decided to give away what Lutnick called the third or fourth best chip so they bent national security a little bit. They think they didn't break it, but they are taking a piece out the door here, which certainly doesn't pass a smell test.
And Bill, I want to get your perspective on how you think Jensen Huang has handled the president, or has been handled by the president, I guess you could say, with his various meetings in Washington and sort of trying to finesse things in NVIDIA's direction.
Well, he's been very astute at working with President Trump. He's made these concessions. He very much wants to do more business in China. Intel in the past has done exactly the same thing. I think if they're not giving their latest and greatest technology to the Chinese, it may be okay. I'm very wary about giving American technology to China where we're in a big race, particularly AI technology. But I think we'll see. My big concern is this is going to spread not just to semiconductors, it's going to spread to other industries. Will we see in pharma where there's a pay-to-play, so to speak, that the U.S. administration will be taking a share of that because the research was done in the U.S. And I would be very, very concerned about that. We seem to be developing much more of a mercantilist approach to our companies and walking right up, if not crossing over the line of the separation between government and free enterprise. That's my biggest concern, Julie.
And Bill, even if Terry is right that this particular type of structure of deal is a one-off, to your point, we have seen a whole host of different flavors of that mercantilist approach that you're talking about. What, in your view, are the risks of that approach?
Well, that we don't have a line between government and capitalism, as you see in many other countries. And I think that's a big concern. How far do you go? The president just directed the firing of Intel CEO with no evidence that yes, he has connection with China, so does Tim Cook, so does Elon Musk. But that should not be prima facie evidence for firing him. So I see the CEO of Intel is hustling into the White House today to try to make peace with the president. But how far will this go? That's my concern. And how much direction will there be to private industry about how to run this company? We have the golden share of Nippon Steel. And so the president's clearly taking an investment, if you will, on behalf of the government in a lot of industries. And I'm concerned, we're just at the start of this administration. How far is that going to go? And we'll see. And also the commitments being made, huge. I mean, like Apple, 100 billion on top of 500 billion, enormous in 4 years. A lot of that won't play out till the end of the administration. But I think these tariffs and other things are going to take effect much sooner.
And Terry, sort of what we hear Bill describing there, what are the implications for investors, both in the case of AMD and NVIDIA, but also just sort of the way that companies need to approach this administration in the future? From an investment perspective, what do people need to think about?
Well, take this NVIDIA AMD story with the 15%. Put it to the side for 1 second. What you've got, though, is a situation where there is much more government direction and aspiration to direct the economy than there was before. The administration has been crystal clear about that, and as a matter of United States policy, as a matter of national security policy. One of Besant's mantras has been for months that U.S. national security policy is United States economic policy. Economic policy is national security policy. You have a situation here where they're doing everything they can, including providing huge incentives to the manufacturing industry to onshore, to use tariffs in part to push different industries to onshore critical materials and goods and the like. They've done everything short of invoking the Defense Production Act, which would essentially harness industry to government aims. Why are they doing that? Because they are urgent about the nature of the Chinese challenge and relatively speaking, how little time they think they have to right the ship, and frankly, harness industry to right-size the economy to meet the Chinese challenge. That's what they think. They've been very transparent about that, and I would imagine that would continue and frankly accelerate. Markets continue to be surprised every time they see something happen, like the United States taking an investment in rare earths. But you can expect a lot more of it. Should not be surprising at all.
Terry, the Journal had an interesting angle on the chip situation in particular, which suggested that because the administration has taught these companies that they can make these commitments and to get an exemption from tariffs, the journal suggested the idea that perhaps they would make some commitments as a sort of way for them to allow import of cheaper chips, for example. In other words, if Taiwan Semi says it's going to spend X amount on building a plant and that's it, it will then import the rest of the chips in order to preserve its margins. They're learning to work the system, no?
Well, they're learning to work the system, but where I think the administration is on, and this is partially circumstantial, but I think a lot of it's borne out by the facts that exist already, is that you get a situation where Trump has demonstrated this kind of tactic. He'll push for a very large and kind of unreasonable goal. The industry will have to come back in and say, essentially, this is the art of the possible. I mean, we can break our necks and metaphorically and hit it as hard as we can and go this far. We can't go all the way. Can you meet us in the middle somewhere? Trump ends up saying yes, but the pressure remains on, and that pattern's going to repeat and repeat.
And Bill, what do you make of all of this, for both from a leadership perspective for these CEOs and how they need to adapt, and also for investors?
Well, I think absolutely Terry's right that this is the way the president negotiates, but the result is going to be much higher tariffs. The tariffs are now in effect, and we're going to see 15% tariffs compared to 2.5%. That will have an impact on inflation. It's not going to be wild inflation. We're not going to go back to 9-10%. Or like we did back in the late 70s. But we are going to see inflation rising up into the 3.5 or something like that, as Goldman Sachs, I think, predicted 3.8 today, but maybe not that high. But we will see an increase in that. I think we've seen manufacturing holding back on their commitments and pushing price increases through. They're going to have to do that, particularly those that have very tight margins, like Amazon, Walmart, Best Buy, are going to have to pass price increases through. There's nowhere else they can find to get these products. There's no U.S. producers of television sets and products like that. So you're going to see these tariffs coming through. They are going to have an impact. I think the real concern I have, Julie, here is we're moving into a period of stagflation. We're not going to see the growth, I would say, closer to 1% than 3% this year. And who knows what it'll be the following year. But I think manufacturers have been holding off on their commitments. They are flush with cash. The earnings are good. They're buying back stock at a rapid rate. But I don't think you're going to see a booming economy like we saw in the past. So I think it'll be a wait and see for companies, and they're going to be very cautious in making earnings projections going forward. The earnings have been strong so far. AI is going to make the tech industry very, very successful and very high investments. But I think we'll have to worry about the U.S. economy. I don't see many job increases coming. First of all, there aren't any employees out there. We may not have high unemployment. It'll still be 4% or plus 4 to 5. But I think we're going to see very few job increases because there aren't employees. There are no immigrants to hire. So this is going to have a big impact in slowing the U.S. economy, the combination of price increases from the tariffs and the lack of growth through job increases.
Well, and there's one more big wait and see that we're waiting for, and that's a deal with China, right, Terry? So, the deadline is tomorrow. All the indications was that it was going to be pushed back again, and yet we haven't heard a peep on that front. So what's going on?
Well, I think it's very likely that it gets pushed back, Julie, but not for any trade-related reasons. You have to remember that, to Besant's mantra before about geopolitics being U.S. economic policy, what the United States wants at the end of this week is forward progress, if not an actual deal on ending the Ukraine war. Russia is a client state of China at this point. And the last thing that Trump's going to want to do, if he thinks he can make forward progress on a Russia deal, is slap a bunch of tariffs, higher tariffs, on China this week. So I think that doesn't happen. But what I would say to you also is that the success or failure of the Russian deals, or the Russian deal at the end of this week, is canary for the markets about whether U.S.-China talks succeed at all. If Russia moves, it's a sign that China's told it to move, and that China may be more likely to reach some rapprochement with the United States on trade-related issues. If Russia becomes recalcitrant and backslides, then you get a situation where China's decided to be tougher across the board, which is worse for a United States-China trade deal.
Guys, really helpful perspective. Terry, as always, reading between the lines in Washington. And Bill, as always, on what CEOs really need to consider here. Really appreciate it, you guys.
Thank you, Julie.
Coming up next, all your markets action. Stay tuned. You're watching Market Catalysts. The Consumer Price Index for July is due out tomorrow. An estimate showing core CPI could have risen 3% year over year. Joining me now, John Hilsenrath, StoneX Senior Advisor and Yahoo Finance contributor. Hey, John, good to see you. So what do you think we're going to see here? And, we always have this debate of sort of which way in their dual mandate is going to carry more weight. After that lousy jobs report, what do you think this CPI report means?
Well, I think the CPI report means a lot because inflation has been above the Federal Reserve's target for 52 straight months. And I think that there's a disconnect between what the Fed faces and what the market expects. The market has been conditioned over the last 25 years to expect a Fed put. When the economy slows down, when the job market weakens, the Fed's going to cut interest rates to save the day. And I think it's just very hard for the Fed to do that when inflation is continually above its target. And I think we're going to see more numbers tomorrow and in the months ahead that are above the Fed's target. So I think the Fed is in a really difficult position, not to say anything of the political situation that it faces.
I mean, there are a few Fed dissenters now. There's going to be one more, not at the September meeting, but after that, if Stephen Myron does get approved as expected. What effect is that going to have then on the thinking when you've got Waller and Bowman in the room arguing presumably for a cut?
Well, I mean, you have a couple of loyalists to the president already there. Waller potentially angling for the job himself, but you have regional bank presidents who have their own agenda. You have a couple of other Fed governors who are holdovers from the Biden administration. So there's no consensus right now that the Fed should be cutting interest rates aggressively. I mean, I think because of that weak jobs report, you're seeing more of the president saying, all right, maybe we need to take out a little bit of insurance, cut rates in September, and then see where we stand. But I think that we've exited a period of Fed consensus for really since the financial crisis of 2008. There's been a lot of agreement at the Fed about the direction of policy. And I think we're in a new period of Fed discord. And mirroring the two governors who are dissenting are kind of the leading edge of that kind of discord. And we're just going to see more of that in the months ahead.
John, you talked about Waller and Bowman, Waller in particular sort of angling for the top job, but he did, he when he has laid out his reasoning for a cut, he's not just pulling things out of thin air. He has really leaned into the idea that the labor market is worse than it looks, and that right. Outweighs the inflation numbers and could eventually have a different effect on the inflation numbers. So, I mean, what do you make of that argument and how persuasive it is?
I agree with you. I mean, I think Chris Waller has made a rigorous and coherent argument for why he would be cutting interest rates right now. And I think that the fact that he's done that and the fact that he's made good arguments in the past about where Fed policy should be are reasons why the market would be very comfortable with him if he were to get the job. Now, personally, I just disagree with his argument. So his argument hinges on the idea that interest rates at 4.3% are restrictive and that they should be closer to neutral, which the Fed estimates is around 3%. That's the core of Chris Waller's argument. I would argue that there's nothing about the behavior of inflation or financial markets, for that matter, that suggests that interest rates are terribly restrictive right now. I mean, stock markets at record highs, junk bond spreads are as tight as they've been in 25 years. There's money pouring into private credit. It's just hard to say that the Fed is really putting a clamp on the economy right now. So, a lot of Fed officials are kind of holding on to this idea from the last 10 years or so that an interest rate at this level is restrictive and a neutral rate is closer to 3%. But the economy is just not behaving as if that's true. So, I think Chris Waller is making a coherent argument, and the Fed is going to discover over the next 6 months that it's just wrong on this. That's my view of where the Fed stands right now.
John, I'm sure we're going to talk again before then, but the Jackson Hole Symposium starts 10 days from today. And Powell has he sort of struggled at first and then learned his lesson in terms of how free he could be with his language at that meeting. So, of course, we don't know what the CPI report is going to show, but what should investors be looking for from Jay Powell at Jackson Hole?
Well, all right. So that's a really good and it's an important question because the Fed has been going through a review process this year about what it says are its long-run policy, long-run goals and policy objectives, right? So this is a review process where they're basically going to reaffirm their commitment to a 2% inflation target. There are people who say, well, maybe the inflation target should be 3%. There are people, the Fed, when it last went through this review process, made this argument that when that they should lean especially hard against low inflation compared to high inflation because of the experience of the post-financial crisis period. The Fed is going to reaffirm its commitment to that 2% inflation target. And I think that's a really important statement right now because, as I mentioned, inflation has been running above that 2% target for 52 straight months. This next round of data that we get tomorrow suggests it's going to go to 53 straight months. And so I think Powell has an opportunity at this meeting to kind of establish his legacy as someone who, let inflation get away from target and then did everything he could to get it back to target. I think that, the market might wake up at that Jackson Hole meeting to the idea that, Jay Powell was really serious about getting back to a 2% target. And what that means is the Fed put that I talked about a minute ago is not what it used to be. The Fed cannot come in when the job market slows down and cut rates as aggressively as it used to because inflation is no longer the cooperative beast that it used to be.
We'll see what happens in Jackson Hole and how the market reacts. It will be fascinating, as always. Thanks a lot, John. Appreciate it.
Thank you.
We'll get a check on the markets from the NASDAQ as well as trending tickers. That's next on Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke Tamamba. We're live at the NASDAQ. Let's get a quick check of the market action. We're about 1 hour into today's trading session, and we're seeing all three major indices. A bit of a mixed picture here. The Dow falling about 0.2% in this Monday morning. The NASDAQ holding on to the momentum as they try to sustain those record closes, two of them in which we saw last week, and the S&P 500 also hoping to hit a record close as well, up about 0.03%. I do want to hit in the NASDAQ, though, because quite the run it's had over the past 5 days. We've seen that index hit about 2 record closes, and now we're trying to hold on to that momentum into this new trading week. We're seeing a mixed picture here as well when it comes to key stocks with Apple, Amazon, and Google falling lower. But if we take a look at equal weight over here, what's really leading the momentum that we're seeing in the NASDAQ this morning is Micron, up about 5%, as well as Intel. I do want to hit quickly on Intel, up about 5% as well into early hours trading here after the CEO is expected to visit the White House today with President Trump after he called for his resignation last week. We saw that company gets under pressure last week, and now we're gaining some momentum in these early innings of this week. Also, Electronic Arts gaining some momentum as well as more calls for that stock to really rally above 170. We did see it cross that target in the market open this week, and now we're up about 4%. And also, I want to take a look at Tesla as well. Tesla, what a year it's been. That stock has really been under pressure year to date, down more than 15%, but getting a bit of optimism here in these early hours of this trading session on Monday, up about 3.3% after a watchdog had said that Tesla has submitted a request to the British energy regulator to supply electricity to UK households and businesses. So we'll see if that bid comes to fruition, but investors certainly excited about the potential opportunity. But once again, all three major indices largely mixed here as investors are really in this wait and see mindset. We have some key data coming out this week. The CPI report is expected to come out on Tuesday. We also have the PPI, the producer price index, set to come out later on this week. And all eyes are on what exactly this will mean for the Federal Reserve. Will we see interest rates be cut at the September meeting? Of course, they're looking at that dual mandate of both maximum employment as well as stable prices. And so all that going into investors' mindset as we make our way into this trading week. But keep it right here in Yahoo Finance. We'll be tracking all the market moves throughout today's trading session.
Now time for some of today's trending tickers. We are watching Micron, Barrick Mining, and AMC. First up, Micron raising its revenue and profit outlook as it sees improved pricing for its memory chips. The company's technology key to building NVIDIA's top AI chips. Analysts cite high demand from hyperscalers for NVIDIA's Blackwell chips as a contributor to Micron's higher sales forecast. Those shares are rising about 4.5%. The stock has been a top performer in the chip sector. It's up over 40% this year. Next up, Canadian gold miner Barrick reporting $1 billion loss in its latest results as it faces issues in Mali, the country's military seizing the company's gold complex. The losses were partially offset by the sale of Barrick's 50% interest in a gold project in Alaska. Barrick's CEO also commenting on tariffs on gold in the company's earnings call, saying it will have a minimal effect on mining companies because they are, quote, price takers. Shares of Barrick under pressure, down by 3%. And finally, AMC topping Wall Street's estimates in its second quarter as big blockbuster releases fueled a 26% rise in theater attendance. AMC's revenue rose by over 35% in the quarter, saw losses narrow to $4.7 million compared with $33 million a year earlier. The share is up by 6.5%. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, we got more markets action for you, including a playbook on pharma. You're watching Market Catalysts.
Navigating how to play the pharmaceutical sector with the Yahoo Finance playbook. Joining me now is Courtney Breen, Senior Analyst of U.S. Biopharmaceuticals at Bernstein. Courtney, Eli Lilly really stuck out to me this week because that stock has obviously had a great run over the last couple years. They are at the forefront of this GLP-1 trend. And then now all of a sudden it's down 20% year to date. It was down 15% off earnings. What's going on? Did we just sort of get expectations sort of overrun where the company's actually at?
Christian, and great to be with you today to dig into this one. I feel like I've been talking about it nonstop since yesterday morning when the results came through. We got two things from Eli Lilly yesterday morning. The first was the orforglipron ATTAIN-1 study, which is their oral GLP-1 drug in the obese patient population. As a reminder for those who aren't watching this super closely, we'd already received one set of phase 3 data for that particular drug, but it was in the diabetes patient population. And in this trial, many investors were expecting to see something in the range of 14% weight loss at that 72-week mark. What we instead saw was 11.5% weight loss at that 72-week mark. And so there was a severe negative reaction from investors. Importantly, what also came out, though, from Eli Lilly on Thursday morning was their earnings, their quarterly earnings. And in that, the most important question that I'd been being asked kind of going into the earnings was, would Lilly raise guidance for the full year? And what we saw with the earnings is that they bet on the top line, and that was particularly driven by both Mounjaro and Zepbound, their GLP-1s in the US, as well as a massive beat in the ex-US opportunity as they ramp up their business there. And then they raised their raised their full year guidance, and the new midpoint is now where the upper end of prior guidance was. This is a big call for Lilly to make that raise to guidance. because last year they made the same move, and yet then they missed in Q3 and Q4. So there'll be much more conservatism being brought into this raise. And so it was a strong signal for that near-term performance, but also really kind of overshone all of that news with the miss, and that really translated to the stock reaction.
And how does that miss work in terms of what happens next with the product, right? I think weight loss drugs have brought a lot of investors that maybe don't normally invest in the pharmaceutical space into it, right? Because they're everywhere right now. People know people that are taking them, and it's become one of those kinds of trades. I mean, what happens next on that front?
Great question. There's a few things. I mean, this isn't the only trial. As I mentioned, we'd already had one in diabetes. We have another overweight trial, kind of weight-focused trial that will be in a type 2 diabetes patient population that will read out shortly. That will then get filed as a package for the overweight and obese indication that they will be seeking then FDA approval on. We expect that FDA approval to come kind of in approximately the midpoint of next year. But those still aren't the only trials. There is many kind of patients in phase 3 trials for this oral GLP-1 product. Something in the range of 16 or 17,000 patients are in trials for this product right now. So it's being very extensively studied. And importantly, they're testing it not only against placebo, but they're also testing it head-to-head against some other oral GLP-1s in terms of oral Sema, which is the new product from Novo Nordisk, and as well as Farxiga, an oral SGLT2 or diabetes drug. So lots of data still to come out. I think one thing that's really important to note, while investors wanted 14% weight loss, that was kind of the bogey number that everyone was anchored on, patients and physicians have a slightly different view. And I think it's important to know that this still looks like an incredibly solid product. I think the big question is just now, what else comes further down the pipe from other competitors? And is there any chance that they could beat this 11.5% placebo-controlled weight loss? Or is this the best that we're going to get, and Lilly's going to retain this leadership position over the long run?
And Courtney, I've only got time for one more quick one for you, but we just zoomed in on Lilly. I'm curious if there's another name sort of at the top of your list in this space that you've been watching as we've been getting these results.
I mean, we're watching the entire market.
Sure.
Everyone's kind of playing and dabbling in the GLP-1 space. What I will say is there is another name that's not in the GLP-1 space, but that I will call out that had a fantastic day yesterday. Another one of our outperformed stocks, Gilead. What's really exciting here is they are innovating also on convenience. They're innovating in terms of the twice yearly injection for HIV prevention. This product is now 6-7 weeks into launch, and we got very exciting kind of positive reinforcement from the company on the management call. But we also got fundamental data that demonstrated both the HIV treatment market as well as this HIV prevention market is looking incredibly strong. So this is kind of a tale of different stories in the convenience space where we're looking kind of consumer-oriented solutions for challenges that exist for our long-term health.
Shares of software maker Monday.com falling by double digits despite the company beating Wall Street's expectations for its second quarter. It also raised its forecast for the full year. The company's sales outlook, though, did come in slightly softer than investors were looking for, in particular for its third quarter. Throughout the software landscape, we have seen the AI transition process with differing results for the different companies. To help us navigate it, I'm joined by Brent Bracelin, Piper Sandler equity research analyst. Brent, it's good to see you. You know, we've been having this discussion over the past couple of years about AI sort of making its way through software, both as a disruptor, but also as something additional that they can sell. So I'm curious, first of all, kind of where we are in that process, if you will.
Julie, thanks for having me here. Yeah, it's been an interesting earnings season. We've seen a lot of volatility in software, and some good, some bad. And as we think about the process, the journey we are in, it really is being dominated today, the AI discussion, by AI infrastructure. It's the Microsofts of the world, the Oracles of the world. These are the companies, the big platforms that are standing up the infrastructure to drive inference as folks start to offload some of these workloads to the machines, if you will. And that's where we've seen most of the upside. As you think about new model releases, obviously there's a big one last week with GPT-5 from OpenAI, ChatGPT, the new version there. A lot of volatility in these software names with the launch of that sense. I think you're seeing a continuation of that with Monday today, some volatility around that. So in the interim, at least at the app layer, I would say there's a lot of hypersensitivity to any sort of kind of blemish, even if it has nothing to do with AI. There's nervousness of does AI drive a disruption to the app layer? At the infrastructure layer, still lots of optimism, accelerating growth, lots of positive things happening in AI infrastructure. So I kind of really see a split, kind of a two-part split here on the AI discussion, infrastructure and then apps.
Well, and there are some software companies that are at the infrastructure layer, right? Like I think of a Microsoft or an Oracle, for example, as being more in that category. So how are you thinking about that, which are in which, and where investors should therefore be looking?
So if we look at prior tech cycles, oftentimes the spend on infrastructure happens first. And then over time, we see either a new wave of applications created or existing incumbents leverage some of these new technologies and roll out new products. It just takes time. I think it's very different. Enterprise spend is very different than consumer. And so it's just going to take time is the short answer. Infrastructure is happening. Apps is just going to take time before you see it show up. And so it's kind of a tale of two cities today, if you will. But it is obviously something we're paying very close attention to. The market paying very close attention to and is hypersensitive to any sort of app company that has a blemish.
And when you get that GPT-5 rollout and you see Elon Musk saying something to Satya Nadella like OpenAI is going to eat Microsoft alive, obviously the guy is prone to statements, right? But is there a kernel of truth in there? Is there a kernel of risk in there for a company like Microsoft?
Yeah, I mean, listen, I think the interesting thing is Microsoft probably has the lowest share of the application market. If you think about kind of front office applications, back office applications, they do have a very big, large productivity app suite for email and Office, but by and large, Microsoft's not a big biz apps company. So I think it's interesting, one, that you saw Lon make that shot across the bow there. But I think it just exposes we're still in the very early days of understanding what can these foundational models do, what is possible, and how much of those traditional apps and workflows change as we start to lean into what these foundational models are capable of. It's taken 2.5 years for OpenAI to kind of release GPT-5. So every 2 to 3 years, we're going to have these moments where we stress test how advanced are the foundational models and how will that impact the traditional status quo and traditional application software.
And then Brent, finally, just quickly, I mean, most of your coverage, you're still overweight, right? So you are optimistic then, implied, in this eventually benefiting these companies. I guess the question is,
Absolutely.
When does that start to happen, and when does it start to show up more in the stocks that have lagged?
Well, I'm hoping sooner rather than later, but the reality is these things take time. If you go back to the late 90s, for those folks that remember, there was a thing called the death of brick and mortar. The reality is my sister and daughter are going to the mall today to go shopping at brick and mortar stores. So I think we're going to go through these periods of time where people over extrapolate the impact of e-commerce back in the late 90s and over extrapolate the impact of foundational models on the death of SaaS today. But the reality is somewhere in between.
I was shopping at the mall in the late 90s, and I do on occasion go to the mall today, Brent, much like your family. Thanks so much. Appreciate it.
You're welcome. Take care.
Coming up, we got full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst. First up, a deep dive into what is driving the market. Can the momentum continue? We'll unpack the state of the retail investor. Plus, how to trade space stocks. We've got the investor playbook after Firefly Aerospace's IPO. And Ford announcing a $5 billion investment to build out its electric vehicle pipeline. We're talking to CEO Jim Farley. All that and more coming up on Market Catalysts. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets. Taking a look at the major averages, we see things turning a bit mixed at this hour. We've got the Dow lower by 163 points now, so under some pressure. We've seen utilities under pressure today. The S&P 500 also down just about 0.1%. The NASDAQ hanging on to gains. It's up about 0.1%. Well, retail investors have been front and center in the market's rally, according to Wall Street. Barclays analysts say retail buyers have been the primary driver of record highs this year, and that momentum is expected to continue. Retail investors projected to fuel a $500 billion stock buying spree through the end of the year. That's according to JP Morgan analysts. Joining me now, Shana Orzik-Sissel, Banrian Capital Management CEO. Shana, it's good to see you. So we have seen this activity happening in the market here. I know you in particular zero in on alternatives, and you offer advice on that realm, if you will. But first, let's linger on public equities for a moment and kind of the trends that we have been seeing there. So much attention, obviously, on the part of retail investors is on the public markets.
Yeah, I mean, you were just pointing to it. One of the trends we've seen recently is that the buy the dip phenomenon. It's the retail investor who has been more right through this cycle. The willingness to buy the dip, the willingness to go in when markets are down and having that bullish mindset. Versus in the past, in history, it had been the institutional buyer. And we've seen kind of a flip where the retail investor has been outperforming largely the institutional investor. And I think that's an interesting trend. We started to see, through the pandemic that the retail investor was more willing to take risk, and risk assets have benefited from that.
Yeah, they've been outperforming basically by just continuing to buy stocks, right? And so it doesn't seem like, to the point of the data we were citing, that there will be any kind of fundamental shift in that strategy necessarily, because the buying has seemed to happen even when the sort of macro tides would seem to be against that logic.
Yeah, so I come from the generation that came into the market right around the tech bubble bursting. So my generation, which is largely the folks in the institutional space, we're a little gun shy. We tend to always expect a downturn in the market because for the vast majority of our early career, it was one thing after another. I think we're coming into a generation, for better or worse, that the market just kept going up. You figure coming out of the financial crisis, 2009, so we're 16 years in. Feels crazy saying that, but 16 years in, and the market has largely gone straight up. We've had a couple of hiccups, but they've been short-lived, and we've seen an immediate move back upwards. And I think now we have a generation that's been their experience, and so they're more inclined to jump in. And if you look back at investor sentiment over time, whether we talk about the folks coming out of the Great Depression, the baby boomers, or the like, they tend to behave, if you talk about behavioral finance, based on how they grew up in the markets. And now we have a generation that grew up in a market going straight up. Again, this could be for better or worse, but I think that's really what drives them and their willingness to jump in and buy the dip, as we like to say.
And Shana, again, you look sort of at the alternative space. Do you think that private markets, crypto, maybe less so, do you think it's going to be a tougher sell to a retail investor that has done so well in the equity market? Will that diversification argument play as well for them?
So let me go on and kind of say this. I strongly believe, even though obviously my entire business is based on the idea that more alternative investments should be in people's portfolios, but I'm also very clear that not every alternative investment is meant for every investor. And so let's just start there. I think there are plenty of surveys out there that you can find that continue to support the idea that the vast majority of retail investors under the age of, say, 50 are completely comfortable and actually want alternative investments in their portfolio. And I would throw crypto in the alternative investment mix. The much younger generation obviously is a huge appetite for the crypto assets. But I would say that the vast majority are looking to have that. The democratization of alternatives, the huge trend in the industry right now is every single major Wall Street organization is looking for a way to monetize alternative investments. How do they get their piece of the pie? Because the demand is there. The problem is less about whether or not there's demand and more so about how do you actually implement it. We can argue about or debate, some of the recent changes that I've seen that I don't actually think are for the best interest of investors. But ultimately, it's coming from the fact that the demand is there. And so these investors do want these investments. Absolutely.
Let's bring in Tom Sosnoff now to the conversation, Tasty Live founder and CEO. Hey, Tom, we were talking about public markets. Now we're talking about alternatives. I'm going to circle back to public in a minute, but I do want to get your take on alternatives and these new rules about what could go into 401ks. What do you think that investors need to know here? And do you think that there is a risk because of the fee structure of things like private equity in particular that maybe retail investors need to know more about?
Listen, there's always a risk when you change up kind of, what traditional or legacy finance has always done with 401ks. But the reality is we have been advocating for probably 25 years now to open up, 401ks. And basically, we started with IRA accounts. We've done a really good job of opening those up to stock options, futures, derivatives, complex strategies, all that kind of stuff. It's about time for 401ks to let people make their own decisions. Of course, there's going to be more risk. And of course, it's going to introduce, new products and new types of risk and new know-how requirements and all that kind of stuff. But the reality is it's good for financial literacy. It's good for the business. And the traditional way of doing things, that was kind of closed anyway. You really didn't know what you were buying or selling when it came to just selecting a fund. You really didn't know what the fees were, and you really didn't know what the performance was like. So I actually think this is a really good step, and it's long overdue.
And so, Tom, I do want to circle back around to the public market part of the discussion here.
Sure.
And you and I have talked about this before with regard to meme stocks, but even more broadly within the stock market right now, the role that retail investors are playing. Does it provide a floor under the market, a higher floor that maybe didn't exist in the past?
Well, clearly, the market needs retail investors. They really balance out a lot of the institutional fluff. And we've argued for a long time that retail investors actually might have a better grip on markets than professionals because they're less about the last quarter is essentially make or break for me. So I think that the retail investors, I'm not sure that they provide a floor, but I think they provide some, they commoditize markets a little bit and they make them a lot more sensible. They're more reasonable because retail investors are involved.
Do you think the retail investors, Shana and I were talking about how sort of the younger generation of investors, yes, they lived through COVID, of course, but that was
Sure.
Unusual. They haven't yet been investing during a longer period, a longer bear market, right? And so does that make them much more risk tolerant than their predecessors?
Well, the challenge for younger investors is that, just like you guys were discussing before I came on, since 2008, 2009, outside of an isolated, very short-term, quick sell-off like 2018 or 2020 or 2022 for a relatively short period of time, or even, last August or this April, all those sell-offs have been very short-lived. And so if you've bought every dip since 2009, you really haven't experienced any kind of a long-term, bear market. So in most people's eyes, and when you look at all the different asset classes out there today, there's virtually no asset class that suffered any kind of a long-term sell-off. So you're right. People haven't experienced some of the things that we experienced in the 70s and in the 80s, and early 90s and things like that. And so, yeah, I think their perspective is a little bit different, but you know what? I don't think that matters. I think you just, it's always been a marketplace. The listed marketplace has always been a place where you have to trade what's in front of you. And you can't really think about what happened, 35 years ago or what happened, even 14 years ago.
Right. And so lastly, I guess I want to ask you guys each a vibes question from the perspective of the audiences that you are interacting with. Shana, you're talking to, wealth managers, RIAs, et cetera, who are your clients. What are their clients' vibes right now? We've got all these sort of macro headwinds. People are still putting money in the market. What's the read you're getting from them?
So the read I get from our clients, like you said, which are the advisors, the wealth managers that work with the retail investors, is obviously there's a lot of demand for these alternative investments. There's a lot of demand for risk, risk assets, crypto, and the like, especially of the younger generations. I think the vibe from that audience, though, that we serve is a little bit of tentativeness. They are really concerned about risk, and we can circle that back to the 401k discussion. I think ultimately the issue here with plan sponsors is going to be the risk aspect of it. And so we spend a lot of time doing a lot of education, because while the demand's there, we haven't seen the flows. And the reason we haven't seen the flows is largely because the product is, kind of fragmented and where it fits, and finding it can be hard. Our industry does no service to that investor by poorly categorizing these things. But really, it's about understanding the risks associated, and nobody wants to, with the regulatory pressures and all kinds of guidance from the Department of Labor and the like, putting pressure on fees. You really need to be able to justify your fees, and advisors want to make sure that they keep the clients. And that's their number one concern. So for us, the vibe is, okay, I'm open to this idea, but help me get my arms around the risk so that I don't lose my client.
Yeah, makes sense. And then Tom, same question to you for the audience that you guys are serving, who are people who are more directly involved in the market.
Yeah, because we serve, the self-directed retail investor.
Right.
But what we're seeing on the sidelines is, and I think, I think this is one of the reasons the market just continues to go higher. And also one of the reasons you've seen some of these crazy moves in IPOs is there is an appetite right now for speculative risk. We call it like an appetite for asymmetric risk. And people, it's indicative of a fairly, let's say, frothy market. It's indicative of a market that may be rich relative, but there's still this incredible demand. And I think, anytime you get to this kind of, it's also a certain level of capitulation, I guess, to a certain extent. That's what creates that frothiness. But there's demand for speculation, and there's demand for a lot of upside speculation. That's why you see these crazy moves in digital assets. You see these moves in IPOs, and you also see these moves in some of these tech stocks. And I think that until everything reverses and they scare the children a little bit, probably more of the same until they flip the cards.
We'll see if and when that happens. I guess it always does. Shana, Tom, thank you so much. Good to see you both.
Thank you.
Thanks so much.
Thanks. Coming up, some trending tickers that we're watching, plus how to play the space trade after Firefly's explosive IPO. That's all next on Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ. Let's get a quick check on the latest market action. We're about 2 hours into today's trading session, and we're seeing all three major indices mix here. If you take a look, the Dow down about 0.3%. The S&P 500 trying to reignite a rally here after it was so close at Friday's market close, and the NASDAQ holding on to a bit of momentum, up about 0.1%, a little more than that, as investors really have a key eye on two key economic data reports that are set to come out, the CPI report out on Tuesday and the PPI producer price index later on this week. That could have major implications on what exactly the Federal Reserve will do come September, as they keep in mind maximum employment and those stable prices. But the NASDAQ in the green, and I want to take a closer look at what exactly is leading a bit to that momentum. We have Intel, Micron, Tesla, MicroStrategy, Electronics, Electronic Arts, as well as others, including AMD, in the green, and that's really holding on to some momentum this morning. Also, we're seeing a bit of a small sell-off in utilities this morning, consumer staples, materials, and energy also in the red this morning. But I do want to take a look at something that is getting a lot of attention. That's Bitcoin. We do see Bitcoin looking to hold on to some momentum here in early innings of this week's trading session, up about 1 percentage point as a new executive order signed by President Trump said that he will allow retirement accounts to include alternative investments like cryptocurrency. We have seen cryptocurrency go on quite the run after that crypto week back in July, and now regaining some momentum in this week's trading session. Once again, all three major indices, a bit of a mixed picture here as they make our way into this week's trading week. But keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout today's trading session.
Now time for some of today's trending tickers. We are watching cannabis stocks, Aventor and Albemarle. First up, shares of cannabis stocks are higher. President Trump is reportedly weighing classifying marijuana as a less dangerous drug. That's according to the Wall Street Journal. The president reportedly told donors privately that he was considering reclassifying marijuana as a Schedule III drug. That would ease some restrictions and allow marijuana companies to qualify for certain tax breaks. Still with me is Yahoo Finance senior reporter Brooke DePalma. Now, this is something that the Biden administration had floated. It's something that had been rumored here, but we haven't really heard much about it for a while until this report.
Yeah, of course, this report from the Wall Street Journal. And this would be an ongoing momentum that we heard the Biden administration trying to start to pursue, but ultimately it didn't go into fruition by the time he had left office. And this would allow these companies to ultimately make more profit. This would allow this reignition, I guess you could say, of these weed stocks. And that certainly has investors really, really excited here. You know, we have MJ moving higher, we have Tilray moving higher. But if you take a closer look at the YF Interactive, I also have that up as well. We're seeing excitement around Canopy growth. That stock up nearly 15%. We also have ultimately general cannabis also moving higher. But keep in mind, this is a sector that has been underperforming over the last 5 years quite significantly after it was so hot going into 2020, extremely hot going into 2019. And now we've seen this major sell-off over the past 5 years as there hasn't been much of momentum or drivers rather to get this market excited. And so the idea that this could reignite excitement, the idea that this could ultimately allow, further profitability for this company is after we hit a bit of a standstill, that has these investors excited and seeing probably the most action that we've seen in quite a while.
Yeah, although short of full legalization, it's unclear what effect this exactly would have. So it'll be interesting to follow it and see what ends up happening. Also on our trending ticker list, let's talk about activist investor Engine Capital confirming it has taken a 3% stake in medical equipment maker Aventor. In a letter to the company's board of directors, Engine Capital said it believes leadership has played a role in some of the company's struggles. And they wrote that leadership, quote, failed to adequately oversee the company's operations, management, capital allocation, and succession planning. So those shares on that getting a pop here of 6%, Brooke.
Yeah, year to date, though, important to note here, that stock is down more than 40%, according to Yahoo Finance tools here. And we're well off the high of $27 per share. Now we're about $12.22. And according to a note from Evercore, that analyst there saying that Engine Capital makes some good points here, particularly on that poor capital allocation. They also went on to say they believe that issues that the company currently has are, quote unquote, fixable. And they see no reason for Aventor to underperform peers. But of course, that it has. Once again, on year to date, it's down more than 40%. And compared to a year ago, it's down more than 50%. And so that company is certainly struggling to keep up with the momentum that we've seen others play out as well.
And finally, let's talk about U.S.-based Albemarle. Those shares are higher after a battery producer, CATL, in China confirmed it will suspend production of lithium from a mine in China after its permit expired. Now, shares are rallying on expectations that prices of the lithium will rise as a result of this lower production. According to Morgan Stanley, that Chinese mine produces about 4% of global supply. This has been a really interesting story to follow today. Apparently, there had been some concerns on the part of Chinese authorities about overcapacity of lithium in China, and so this might be one of the reasons that this is happening. But you do see that ripple effect around the globe, Brooke.
Yes, certainly. We're seeing that effect hit this stock as well. And keep in mind, this company has had some momentum going into this latest announcement, or rather tailwind that has brought to it. On August 4th, we saw that Deutsche Bank raise its price target from $65 to $74, and that certainly gained some momentum as well. The stock now is up more than, or nearly 17% in the last month alone, after it's had quite the run year to date, down more than 3.5%, and it's up about just 1% on the year. But heading into this announcement, we are seeing some optimism among the street on what exactly this can mean. But keep in mind, this is a company that has 15 holds, 11 buys, and about 5 sells. So there certainly is mixed feelings about where exactly this company could lead to. But ultimately, on this report, it's up now about 9%.
Yes, thanks so much, Brooke. Appreciate it. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Firefly Aerospace made its initial public offering on August 7th, raised over $868 million. The stock has since pulled back from its $70 a share debut. Currently, it's around $50 a share. Firefly's IPO, just the latest example of what has been a closely watched space race that includes established names like Boeing and, of course, private companies like SpaceX. Joining me now with his take on how investors can play the space trade is Andrew Chanin, Procure AM co-founder and CEO, the operator of a space ETF as well. Andrew, it's good to see you.
Thanks for having me.
So let's talk Firefly here, as sort of emblematic of the interest in this industry. Sold shares to the public at 45, spiked there to open up, now trading around 50. But certainly it does seem like there is a lot of interest in space right now. What do you think of Firefly's entry in particular?
So for Firefly, they've had revenues, albeit very, very small compared to the market cap that we're currently seeing. But I think this company saw a really exciting time in the IPO window, where originally they were expecting somewhere maybe in the $2 billion range for the market cap at IPO. They saw once the stock started trading last week that it hit up to about 9.8 billion in market cap, so well above what they were originally expecting, and that allowed them to bring in roughly, as you said, under $1 billion in cash, a little under double what they were originally expecting. So that could certainly help the runway for a fairly new public company in the marketplace.
We had the chance to talk to the Firefly CEO, and I thought he talked a little bit about the part of the space sector that they occupy. I want to play for you what he had to say.
There's no one-size-fits-all rocket on the market, and you can see that in the at sea transportation, air transportation, and in space transportation as well. So we deliberately chose at Firefly the small to medium 1 ton to 16 ton market, and it was a really great choice.
I think historically, Andrew, there has been this approach that people just wanted to be in space. Do you think as the sector matures a little bit that there will be that sort of differentiation and say, okay, well, this part of it is most attractive or that part of it is most attractive?
We'll see, certainly. As far as talking about, the size of payloads for launch, a company that specializes in, smaller, lighter types of payloads won't necessarily be able to go out and compete for some of the really large contracts that needs to send very large items or a lot of items to space in a very short amount of time. But there are many new competitors that are even players coming to the space market, which have helped drive down the cost of launch. Certainly SpaceX being one of the most important with the advent of reusable rockets. But this ability to get the cost of launch down is bringing many new potential spacefaring companies to the marketplace. And they're these immediate beneficiaries of this lower cost of accessing space. So to the extent that they could find a robust pipeline of clients, whether that be government, commercial, or other, is going to be up to their marketing and sales team to be able to line that up. But there certainly is what we're seeing, a very strong demand for launch, specifically with various satellite constellations that are going up, and some of them with a time crunch where they need to get a certain amount of satellites up within a certain amount of years, or potentially lose the ability to get the remaining half of those satellites up.
Andrew, SpaceX sort of the dominant player here. I mean, if they came public, would that just suck all the air out of the room in terms of where the money would flow?
It's tough to say. Certainly, they've been seeing a lot of success being able to raise capital in the private markets. They do roughly 2 tender offers a year, and they've been showing consecutively the ability to raise at a higher and higher perceived market cap for the company, which has been helpful, and a reason that for them they may not look to go public so soon, being that they are able to access these private markets. But to the extent that they do go public, it does seem like there could be a lot of investor demand. Right now, it's pretty difficult for individual investors to get access to that name, but they're also not the only space company in town. And we have seen what seems like a slightly newer perception of how investors are looking at the space industry over the last year or so, following the kind of post space SPAC IPO malaise.
Your ETF in particular, UFO is the ticker, cute, is up almost 30% year to date. What do you see the performance like going forward? And of course, when you're talking about these space companies, the ones who are shooting rockets into space, there's some volatility there in case they have a failed launch, for example. So how much how much visibility do you have on the performance of these names?
So for better or worse, I'm not allowed to make projections, predictions, or estimates. However, we have seen a lot of interest coming back into the space industry over the last year plus. And some of these names were names that people weren't very familiar with. So names like AST Space Mobile, is a name that is not in a lot of ETFs. And, last year back in May, it started making a pretty major run, which I think got a lot of investors excited. And it has become kind of a retail darling for many investors looking at the space industry. And so we do have some of these more diversified primes in the space industry that are household names. Many people are more familiar with them for their aerospace and defense backgrounds, but they're also major contributors to the space economy. Something like UFO, our ETF, is a global equity ETF that's looking at space companies from around the world. So while we may see certain companies that are being traded because people expect that they might win some lucrative Golden Dome contracts, that might be something completely different from why maybe a European space company like Avio, based out of Italy, may be seeing some recent success, where European companies are maybe not as willing to partner with American or SpaceX as a specific example, and are looking more for internal solutions. So what we're really seeing is kind of a reshaping of the global space market. It's going to be tough to tell who the winners are going to be several years out in the future, but we do know that there is a significant amount of satellites that need to go up for some of these approved constellations. And those launch companies that are able to have supply and readiness to send these satellites up could be really interestingly positioned in the future.
Andrew, we'll keep an eye on it. Thank you so much. Appreciate it.
Thank you.
Checking back in on Canadian gold miner Barrick, the company topping analyst estimates in its second quarter with earnings per share 47 cents, revenue of $3.68 billion. Meanwhile, Barrick reported a $1 billion loss in its Mali business after the country's military seized Barrick's gold complex. The Mali losses were partially offset by the sale of Barrick's 50% interest in a gold project in Alaska. Barrick's CEO also commenting on reciprocal tariffs on gold in the company's earnings call, saying that will have a minimal effect on mining companies because they are, quote, price takers. Right now, those shares pulling back by nearly 3%. Coming up next, we are going to be catching up with the CEO of Ford, Jim Farley. Stay tuned. Ford announcing a new $2 billion investment to expand its U.S. manufacturing footprint, calling it a Model T moment for the company with its next EV coming on an all-new platform. Yahoo Finance senior autos reporter Pras Subramanian has Ford CEO Jim Farley with him for more details. Pras, take it away.
Hey, Jim, thanks for joining us. Appreciate your time here. So, Jim, talk to me about this new Ford EV universal platform. Like, you're going to make this new midsize pickup on that platform. How is it going to sort of change things for Ford? A kind of a big departure for the company.
It's a huge change for us. We're going to change the way we build vehicles, maybe the way the industry builds vehicles. We're going to build a vehicle in 3 separate pieces and join them at the end of the process. That allows us our workers to get inside the vehicle and to kit the parts, not on the side of the assembly line, but in the vehicle. The whole vehicle has been engineered for radical simplification as well. We have 20, 30% less parts depending on the vehicle. It's just a totally different approach for simplicity. And we have a new battery chemistry, LFP, that we'll make in Michigan. It's a $5 billion bet on U.S. manufacturing. We think this is the way to beat and beat BYD.
So Jim, that first vehicle will be a mid-sized pickup, I believe, with more space than a RAV4 apparently. Why do you think that's the best sort of footprint for that car now? And I understand that more cars will be coming after.
Yeah, we'll have different body styles. We want to start with the most universal car. This is what we think Henry Ford would have loved. Because a RAV4, let's say the best-selling passenger car in the U.S., great car, it's a hybrid. We have the Escape hybrid. This has more room inside, but then you have lockable storage with the front, and then you don't need to carry your bikes and all your work equipment on the roof, or with the tow hitch mounted system, you can all put it in the bed of your truck. This is a more universal vehicle. And we have a lot of other innovations we haven't shown people yet, where this mid-size truck will really not be a truck anymore. It's more like the ultimate next generation crossover.
So Jim, is this sort of the way that Ford and other, even Western automakers, can take on the Chinese, even Tesla, with sort of the smaller footprint, simpler manufacturing process?
Yes, this is it. This is a way to go. Look, we can go like others do and make their affordable EV in South Korea and Japan and import, but that's not what we're doing at Ford. We challenged ourselves 3 years ago with the Skunk Works team to approach everything differently. Radical simplification, new battery chemistry. The battery's actually the vehicle structure itself. It's not put in the vehicle, it is the vehicle. We build the seats on the battery, build the front and the rear separately, and combine it. This radically reduces our cost, including a 30% cheaper battery chemistry, and the battery usage is much lower than a BYD, like 20% more efficient. And we think this is the way we can make money on EVs. We've learned a lot. We've been number 2 to Tesla for a couple of years. We've been doing our homework for this next investment cycle, and this is the way for us to be competitive.
Do you think the loss of the EV tax credit is something that might play into this and make it easier to sell cheaper EVs in general?
Yes, absolutely. We've learned so much, but that $7,500 is going to go away in September. It's going to have a big impact on the market. And we didn't know that when we started designing this vehicle. We wanted to just make a profitable vehicle at entry. But what we started to learn is, look, people want to commute. That really, the duty cycle that matches an EV on the retail side, not commercial side, is definitely short-term trips. Someone who charges at home, they go no more than 300 miles on a charge, and they don't want to go to the gas station. And for them, this vehicle will be cheaper to operate than a RAV4 hybrid or even a 3-year-old Model Y, and there's a lot of those on sale. This will be a lot cheaper for those customers. Not for everyone. We have Super Duties and Broncos and Mustangs, but for that subset of people, this is a much cheaper. They can spend that money on vacations and a lot of other things.
Policy sort of weighs in here. You mentioned with the EV tax rate, but also we're talking tariffs, and that's sort of affecting the affordability question. What's your sort of big high-level picture on what's happening here with, preliminary trade deals with Japan and South Korea, but still higher tariffs on Canada and Mexico, where we build a lot of trucks and using U.S. parts? What's your take on that?
Well, I think I'm optimistic that we'll find a way to work through the issues in Canada and Mexico. We're disappointed. We want a level playing field. 15% tariff in South Korea and Japan, not a level playing field. That's still a $5,000 advantage to import. But we're not gonna focus on that. We have a great relationship with the Trump administration. They're totally aligned with us as the biggest car company in the U.S. They want us to make these billion-dollar investments like Louisville today, and we are going to find a way, working with Howard Lutnick, the Commerce Secretary, the President, his whole administration, we are going to find a way to minimize those parts tariffs on America's biggest car company. We cannot be disadvantaged by betting on America, and we have confidence in the President that we'll work this through.
Betting on America is sort of thing that a lot of the big three has been doing recently, especially Ford in particular. But I wanted to talk to you about America in general, the U.S. consumer. How does that consumer look to you at this juncture, and sort of the big picture auto sector in general? Where are we headed next? Well,
no doubt, affordability is the biggest issue for customers. Yes, they want modern drivetrains, they want hybrids, they want e-revs, they want electric, they want combustion, good diesel engines, they want all those things. What they really want is affordability. Our industry is getting close to $700 to $800 a month as a normal payment. More and more customers now buying 84-month financing, 7 years now to own the car. Quality is getting better, but we as an industry need to innovate, just like we are with this Ford Universal Electric platform, to bring the cost down of our vehicles and also to make money. The customers aren't helped if we subsidize these cars. You know, that's too risky for our workers, for our community, and for the customer. And that's why we innovated here starting 3 years ago.
Jim, a lot of news today. Model T moment here for you guys. Thank you so much for joining us, and congratulations on the new platform.
Thank you.
All right, Julie, back over to you.
Thanks, Pras, and thanks, of course, to Jim Farley. Coming up next, breaking down data coming out of the Bureau of Labor Statistics. We're taking a closer look at how that information is gathered ahead of tomorrow's CPI report. You're watching Market Catalysts.
President Trump has been a loud critic of government data, most recently shocking investors and policymakers when he fired the Bureau of Labor Statistics Commissioner. Trump making that decision following his claims that the weaker than expected July jobs report was, quote, rigged. But how exactly are these economic data points collected? Let's get over to Yahoo Finance's Jared Blickery, who has a breakdown.
Yes, Josh, the political fire is hot, but the numbers underneath it are what really matters. So let's check them out and look at these bars, which was what first was reported way back in May. And when that was released, it was 158,000 new jobs. And in June, we saw an increase of 140,000. That you can see on your screen in those big green bars. But when the July numbers dropped, and they weren't that great themselves, those two prior months shrunk dramatically to 19,000 and 14,000. That is 250,000 jobs gone, the biggest 2-month downward shift outside of a recession since 1968. But remember, that first number is basically a rough draft, and history says it can miss by about 130,000 either way. So big swings, they happen. And the bottom line is 3-month hiring is now at a modest 35,000 per month, and this is not what we consider boom times. Now let's tour the data factories. First up, we have the Bureau of Labor Statistics, It cranks out jobs, inflation, and vacancy numbers with a turnaround of about a few weeks. We're going to dive into the particulars here in a minute. Next up, we have the Census Bureau. Think retail sales, housing starts, factory orders. It has the same fast clock measured in weeks. And then we have the Bureau of Economic Analysis, or BEA. That's where you find gross domestic product, consumer spending, and a different look at inflation. Now, the star of today's show is the Employment Situation Report. It's a monthly snapshot of payrolls, wages, and joblessness. It's based on the week that includes the 12th of the month, and it usually drops the first Friday of the month. The BLS uses 2 different surveys to put this report together. One is called the Household Survey, which, as you might guess, surveys households across America. It comes from calls and online forums to about 60,000 families. Who's working? Who's looking? Who's sitting out? The other half comes from a survey of businesses that hire the workers. That's called the Establishment Survey. And it comes from emails and web forms sent to roughly 120,000 employers. That's where the headline payroll figure comes from. That's the source of all this recent controversy. The problem is fewer forms are coming back. Over the last decade, and this chart shows this, household responses slid from about 88% to 68%, and business responses, they tumbled from 61 to 43%. And you can see in that chart that it was really the pandemic that slowed the response rate, and things have just not bounced back. Less input on day one means a bigger cleanup crew later, and that's why revisions can look jarring, as they are right now. On top of the monthly tweaks, guess what? Every February, that brings what's called the benchmark revision. Payrolls get matched to tax records, and this year it erased nearly 600,000 jobs from 2024. But the original benchmark revision was even higher, 818,000, which was another data point that President Trump recently measured. So if you're following along here, even the revisions get revised. Now, at the last Federal Reserve press conference, Fed Chair Jerome Powell put it this way: government data is the gold standard in the U.S. We need it to be good, and we need it to be reliable. And that gold standard now sits with a new acting commissioner at the BLS and his team of statisticians. The next jobs report drops Friday, September 5th, and we're going to be sitting here on pins and needles for the next draft of the truth.
Stocks mixed ahead of key inflation data out this week. The July Consumer Price Index expected to show inflation rose 2.8% year over year, closer to 3% on a core basis. Joining me now, Bill Adams, Comerica Bank Chief Economist. Bill, good to see you. So you see unemployment holding steady. So how is that relationship going to work with the CPI numbers we're getting tomorrow?
So we're thinking of this for what it means for the big picture for the economy. And the economy was in low gear in the first half of the year with 1.2% real GDP annualized in the first and second quarters. Now, as you covered, we've got that slow jobs report for the 3 months through July. But inflation is also picking up, we expect, in the July CPI report. I think we'll see year over year increases in the CPI and of the core CPI edging up. And for interest rates, that puts the Fed in a tough spot. The Fed targets maximum employment, but also stable prices. And so it's hard for them to support the labor market with lower interest rates if inflation is rising.
So the market seems to be pricing in a very high likelihood the Fed's going to cut in September. Do you think that's a mistake?
I think that there is a bigger chance that the Fed holds rates steady than financial markets are prepared for. The Fed targets maximum employment, which means the most people employed that the labor market can support. And labor force participation has been coming down this year. Labor force participation can be cyclical, but given the big changes we've had in immigration policy in 2025, that's likely playing a large role. And so I think the slower job growth that we've had this year is likely also keeping pace with slower growth of people entering the job market and looking for jobs. So if the unemployment rate holds steady at that next jobs report out in early September, I think the Fed could decide to hold rates steady at that decision and see if the effect of tariffs on inflation is one-off as people are hoping, or if it ends up being more persistent.
So what hints are you going to be looking for specifically in the CPI report that will let us know about the sustainability of some price increases?
So it's not going to be any surprise to see higher prices of consumer electronics, higher prices of appliances, higher prices of furniture. These are all goods that we know are going to be affected by tariffs. What I think will be more interesting to financial markets is what happens to service prices in the CPI report. So this is the price of food away from home, the cost of auto insurance, and also the cost of shelter, which accounts for about 2/5 of the core CPI basket. If shelter costs are rising more slowly, then that can offset a lot of the impact of higher tariffs, raising the costs of consumer manufactured goods, and help to keep overall inflation under control. There are a lot of signs that the housing market is cooled this year, with smaller increases of house price indexes and smaller increases in advertised rents for renting households. So if that shows up in the CPI report as well, then I think the Fed would feel a little more comfortable. We'll see about this September decision, but we'll feel a little more comfortable signaling that rate cuts are on the way, at least at one of the next couple of decisions.
And Bill, I'm also curious your thoughts on economic growth, right? Because most economists seem to have taken the idea of a recession off the table, or at least lowered the odds considerably. But do you think we'll get slowing growth, and if so, how dramatically?
The economy looks like it's still in low gear in the second half of the year. You have to keep in mind that tariffs are a form of a tax. They're a tax on American purchases of imported goods. And so this tax hike, given the tariff rates that have been announced to date right now, looks to be about 1.5% of GDP in higher effective taxes. So that's a pretty substantial tax hike, and tax hikes tend to slow the economy near term. But in 2026, the tax and spending bill passed on July 4th is going to come into effect, and that will be a big decrease in effective income tax rates for households and for businesses, and likely offset the effect of the tax hike that we've experienced this year. So I think the slowdown that we're experiencing right now is probably temporary because of that, and I expect economic activity to gain traction after the turn of the year.
We'll be watching those numbers in the morning, and then the numbers beyond that. Bill, thanks a lot.
Thanks for having me.
We're following some breaking news out of the White House. President Trump confirming in comments to reporters that NVIDIA indeed will pay the government 15% of the revenue from its China chip sales in exchange for export licenses. Now, we're talking specifically in the case of NVIDIA about its H20 chips. Remember, those are the less advanced chips that the company developed in order to be able to sell to the China market. Before then, those sales were suspended by the U.S. government. The export licenses were suspended by the U.S. government. NVIDIA had said recently, well, we expect to get those licenses once again, but then they weren't actually issued. Now it looks like they have been issued in exchange for this agreement with the U.S. government. And Trump saying to reporters that he initially said he wanted 20% of those China chip sales, and then Jensen Huang negotiated it down to 15% again. And so, the sort of back and forth had to do with whether the U.S. would competitively be at a disadvantage if it did not export some of these chips into China. We'll continue to track this developing story. And that's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We got more Yahoo Finance coming up.